Okay, so you want to own a ranch. It sounds like the ultimate symbol of wealth. Thousands of acres stretching to the horizon, cattle grazing under open skies, expensive pickup trucks, horse barns, private lakes, maybe even a luxury lodge that guests pay thousands of dollars to visit. On paper, it looks like you've escaped the city and built a business where nature does the work. Now imagine this. You own a 5,000-acre cattle ranch worth $25 million. Beef prices are strong, your herd is growing, land values keep climbing. From the outside, you're sitting on a fortune. But there's one problem. Your bank account is nearly empty. How can someone own millions of dollars in land and still struggle to pay next month's bills? Because a ranch is one of the most asset-rich and cash-poor businesses on Earth. Read that again. The value of your land might increase by millions over a decade, but appreciation doesn't buy diesel fuel. It doesn't repair broken fences, it doesn't pay ranch hands, and it certainly doesn't feed thousands of cattle through a drought. That's where most people get the economics completely backward. They think they're buying livestock. They're actually buying exposure to weather, commodity markets, interest rates, labor shortages, disease outbreaks, and one of the most capital-intensive industries ever created. Every sunrise starts another meter running. Fuel, feed, equipment, veterinary care, property taxes, insurance, water infrastructure, machinery maintenance, debt payments. The cows don't care whether beef prices are high or low. They still need to eat. Neither do your lenders. And unlike software or digital businesses, you can't pause operations during a bad year. Living assets continue consuming cash every single day. That's why some ranches survive for generations while others disappear after only a few difficult seasons. The difference isn't who owns the most land. It isn't who has the biggest herd. And it isn't even who sells the most beef. The real business of owning a ranch isn't raising cattle, it's managing risk. Because in this industry, the land creates the illusion of wealth, but cash flow decides who keeps it. Before you can understand how a ranch makes or loses money, you have to realize that not all ranches are playing the same game. People hear the word ranch and picture the same business. A few thousand cattle, endless grassland, and a cowboy riding into the sunset. In reality, the industry is divided into entirely different economic models. Let's start with the smallest tier. A small family ranch might cover 200 to 1,000 acres and cost anywhere from $750,000 to $5 million, depending on location and water rights. These operations usually manage a few hundred head of cattle while relying heavily on family labor. Profit margins are often thin because the owner wears every hat: manager, mechanic, bookkeeper, and ranch hand. One unexpected drought or equipment failure can erase an entire year's income. Move up to the commercial ranch. Now you're looking at roughly 2,000 to 15,000 acres with purchase prices ranging from $8 million to well over $50 million. These businesses employ full-time staff, operate expensive machinery, maintain miles of fencing, and often diversify into hay production, hunting leases, or breeding programs. Scale lowers certain costs, but it also magnifies every mistake. A 5% increase in feed costs can translate into hundreds of thousands of dollars in additional expenses. Then there's the premium legacy ranch. These properties can exceed 20,000 acres and sell for $100 million or more. At this level, cattle may no longer be the primary source of value. Instead, the ranch becomes a portfolio of businesses: high-end guest experiences, trophy hunting, conservation programs, premium genetics, mineral rights, renewable energy leases, and appreciating land values often generate as much or more than livestock itself. Notice what's changing. As ranches become larger, they're not simply adding more cows, they're adding more revenue streams. Because the biggest operators learned something decades ago. A ranch with only one source of income is betting everything on a single commodity market. A ranch with 5 independent income streams can survive when one of them collapses. And that single distinction separates lifestyle ranches from businesses built to last. So you've found the perfect ranch. The purchase price makes sense. The land is productive. The herd is healthy. The numbers look manageable. Unfortunately, the purchase price is only your admission ticket. The real spending begins after you own it. Let's start with the obvious costs. If you're buying an operating cattle ranch, you'll likely need tens of millions of dollars in land, livestock, equipment, and working capital. Even a modest commercial operation can require hundreds of thousands, sometimes millions, of dollars in tractors, loaders, trailers, ATVs, cattle handling systems, water tanks, fencing materials, and storage facilities. None of those assets generate revenue while they're sitting in the yard. Then comes the hidden capital. Miles of fencing eventually fail. Wells require drilling or repairs. Pumps burn out. Roads wash away after storms. Barn roofs leak. Corrals deteriorate. Every acre demands maintenance. whether cattle are profitable that year or not. Now add operating expenses. Diesel fuel powers nearly every activity on a ranch, and fuel prices rarely stay predictable. Veterinary bills arrive whether calves are worth record prices or not. Feed becomes dramatically more expensive during droughts, forcing operators to purchase hay that can cost several times more than in normal years. Property taxes, liability insurance, workers' compensation, and equipment financing continue every month without exception. And then there's labor. Experienced ranch managers, mechanics, veterinarians, and equipment operators are becoming increasingly difficult to hire. Higher wages help attract workers, but they permanently increase operating costs. Here's the expense most new owners never calculate: time. A broken water line at midnight can't wait until morning. A disease outbreak spreads while you're sleeping. A wildfire doesn't care that it's the weekend. Unlike many businesses, a ranch operates every day of the year because the inventory is alive. Think of the economics like owning hundreds or thousands of biological factories. Every animal consumes resources continuously, regardless of market conditions. If revenue slows, expenses don't pause alongside it. That's why experienced ranchers don't fear buying land. They fear running out of liquidity. Because bankruptcy rarely happens when the ranch loses value. It happens when the cash needed to keep everything alive disappears first. At this point, you might think the ranching business is simply about producing more cattle, more calves, more beef, more revenue. That's the mental model almost everyone starts with. And it's exactly why many ranches struggle. Because the highest performing ranches don't maximize herd size. They maximize the value created by every acre. Think about it like owning a hotel. Adding more rooms only helps if every room earns enough to cover its share of the building. A room that sits empty still costs money to maintain. In the same way, every additional cow consumes grass, water, labor, veterinary care, and working capital. Bigger isn't automatically better. Let's put simple numbers behind it. Imagine 1 acre produces enough forage to support 1 animal unit. If that acre generates $120 of annual profit from cattle, that's your baseline. Now lease that same acre for seasonal hunting rights and earn another $40. Install a renewable energy agreement or communication tower and add another $30. Sell premium breeding genetics instead of commodity calves, increasing profit by another $60. Suddenly, the same acre isn't earning $120. It's earning $250. The land never changed. The business model did. That's the hidden profit engine. The smartest ranch owners stop thinking like cattle producers and start thinking like asset managers. Some develop direct-to-consumer beef brands that capture retail margins instead of wholesale prices. Others focus on registered breeding stock, where one superior bull can sell for tens of thousands of dollars. Many generate reliable cash flow through hunting leases, guest lodging, conservation programs, mineral royalties, or long-term energy contracts that continue regardless of cattle prices. Notice the pattern. Most of these revenue streams aren't tied directly to the number of cows on the property, they're tied to the value of the land itself. That's a crucial distinction. Commodity businesses compete on price. Asset businesses compete on utilization. The ranch doesn't become dramatically more profitable because it holds more livestock. It becomes more profitable because every acre works multiple jobs at the same time. And once you understand that, you realize the cattle may be the most visible part of the business, but they're often not the most profitable one.